You have understood. We had discussed the 4 quadrants of question marks, stars, cash cows, and dogs. And we were discussing the strategies ahead. When the companies, they analyze what is the position of that particular business. Now here, when I say it's a portfolio analysis, so here a corporate giant may think of having different businesses, or assessing of different businesses, or assessing of different product lines. So both of the possibilities are there, that one company can think of having the portfolio analysis as far as the product lines are considered, as well as the portfolio analysis when the different businesses in which the company is operating, even that is taken into account. So here there are 4 strategies which can be thought of from the organization's point of view. The first one is the build strategy, where the company thinks of increasing the market share. Now here profit is one objective and increasing the share market is the other. So building emphasizes more on increasing the market share rather than profits. So here when the company thinks of having this specific objective, then only it can think of having the strategies to increase the market share. So companies think of having the market skimming strategies, entering into the market rapidly, maybe by decreasing the price, or by having the small packages of volume of the product, anything. This is specifically for the question marks, whose market share must grow in case they are to become the stars. Then only the companies think of having this build strategy. When one thinks of having the hold strategy, that is to preserve the market share. Now this is the scenario when the competitor enters with the better product in the market. When something the competitor enters with the new technology, or maybe when there is a threat from the competitors, the companies think of preserving the market share. In today's competitive market, nobody wants to lose their market share. So in case of holding, the company thinks upon the applying the strategies to hold the market share. Now this is specifically for the strong cash cows. If they are yielding a positive cash flow, and in future also, if they generate more cash flows, then the company thinks of, the organization thinks of holding the market share. Next is the harvest. Here the objective is to increase the short-term cash flow irrespective of long-term effect. So here it is quick money, getting the quick profits. That is the objective. Maybe here it involves a decision with reference to withdrawing from the business, a cost-cutting strategy ahead, or the company plans to cash on its crop. Now, it generally thinks of decreasing the expenditures on research and development, on advertising, on not replacing the plant or the equipment, machineries which wears out. and hence it thinks of increasing the positive cash flow by decreasing some of its expenditures. Now, this strategy is more appropriate for weak cash cows, maybe whose future the company doesn't know, it's very much dim, and from which more cash flow is needed. Now, the harvesting can also be used for question marks and dogs, where the company is carrying out harvesting strategy. It faces the problems with reference to social and ethical questions, and to share the information with the various stakeholders while coming up with the strategies or framing the strategies. Now, the next strategy is the divest. Here, basically, the objective is to sell or liquidate the business, as the sources can be, these resources can be used better in some other options. This strategy is more appropriate for dogs or question marks. Those who are not performing that well, and here the company has a doubt whether the products will perform or whether they will go on a positive note as far as generating the cash flow. Generation of cash flow is considered. Now, here the company should think about the option of harvesting or divestment. Which strategy is more appropriate for weak businesses? Now, harvesting, it reduces the business future value, and therefore the price at which it could be sold in future. Now, in contrast, if it is likely to produce a fairly good bids in future, then one can think of having the businesses in the relatively good shape and of more value to the other firm. So here it's a critical decision which the companies have to analyze. Now, also strategic business units, different strategic business units or different product lines have their own cycles. One has no comparison with the other firm or other product lines. So companies should not only examine their businesses from the current perspective of growth share matrix, but in future, down the line, what would be the scenario that should be taken into account? Now, here there can also be the mistakes from the company as to now here all SBUs to aim for the same growth rate of return. Expecting this is a mistake, because each and every market is different. Each and every field in which the businesses are operating is different. So one cannot compare with the insurance business with the healthcare business or with the petroleum industry or FMCG category. If in case of portfolio analysis, if the companies are taking different strategic business units who operate on a various note, then in that case, there is no comparison in between these businesses. Maybe today one is performing on a lower level and the other is performing at a better level, but tomorrow the scene may change. The reverse may be the case here. Now, here another mistake is to include the cash cows with too little in retained funds. In case these cash cows they grow weak, or leaving them with too much in retained funds. Making major investments in dogs in the hopes that the position will improve, or maintaining too many question marks, and under investing in each. So these could be some of the problems or mistakes the company may undertake. Now, this is about the BCG matrix. If we consider the advantages, it allows a framework to allocate resources. So here, when the companies have to allocate the resources to invest, when the companies have to think about the investment decisions, then in that case, these frameworks will act as a ready reckoner to give a clear picture about which of the businesses or the product lines require the investments to be done and which are performing much better. Now, since these four quadrants are there and the mapping is much more easier, it becomes very simple and easy to understand. It also helps in analyzing the gaps and screening the opportunities for the organizations. As far as limitations is considered, now here, this method includes two dimensions, that is the relative market share and growth market share are the only the two dimensions. Yeah. The problem is the businesses with low share market are also profitable many a times, which is neglected. Also, the companies with the small market shares that have fast growing market shares, fast growing potentials, I mean, they are also neglected by the organizations. These are some of the limitations. Now, I would like to discuss one example with reference to BCG. If we take Nestle, okay, it's into FMCG leading company. So here these are some of the brands. Like, just have a look at the slides. So it started with the Nescafe, then it went to the iced tea option, Nesplus, the crunchy granula. These are the new products which it launched, recent ones. Kit Kat is there in the market since a long time. Even the Milky Bar and the Munch, they have the competitor, that is the Cadbury's, against them, the brand. Nestle Milkmaid enjoys considerable market share as far as the yogurts, flavored yogurts are considered. It is again a market leader also in terms of probiotic products like probiotic dahi. Nestle Slim, the company introduced it, and this is where lies the cash cow. It entered with the Maggie brand, the noodles brand, and then shifted to variants in the same brand. That is, it extended the same Maggie brand to other products also. If you see, this is a much well-performing product line of Nestle. Also, the baby products. Cerigro is the brand. Okay, now these is with reference to portfolio analysis of product line for the company. Now, Nestle's, if you take into account the cash cows part, Nestle's Maggi noodles, Nescafe, and its popular chocolates like Kit Kat or Munch, they are the cash cows with a market share of 80 to 85% for Maggi noodles, which holds a pseudo monopoly in the market and high customer loyalty. Now, today it's facing, it has to maintain its market share as the other competitors have entered in this field. Similarly, as far as the stars quadrant is considered, Nestle's mineral water, that is Pure Life, and Nescafe coffee, like Nescafe Latte, are the stars for the company. There is no threat for this Nestle's Nescafe brand here. Mineral water, yes, there are competitors, but Nestle is able to survive as far as its position is considered with reference to competitors. Now here, Nestle Slim brand and Milkmaid are some of the milk and milk-based products from the house of Nestle, which needs higher investment. As far as Milkmaid is considered, they are into question marks, but still it has enough market share. But Nestle Slim is totally into the category of question mark. The company doesn't know whether in future it will move ahead, or maybe the company has to withdraw it. Also, the new coffee smart maker, which the Nestle has introduced. Here also there is a question mark. Now, two of the brands comes into this pets or dogs categories, which is Milo and Coco Crunch. Milo has not been able to sustain in competition with reference to other brands like Bonvita, Complan or Horlicks. In comparison to those brands, here the Milo brand has a very low weightage. So like this, the company thinks of having the portfolio analysis of the different product lines. So this is just an overall picture of Nestle company. Now, any doubts as far as the BCG matrix is considered? Hello.
No, ma'am.
Ahead with the next important part, that is the General Electric model. Now, these two are the models which are helpful in terms of portfolio analysis for the organization. Now, since there was a limitation as far as the BCG matrix is considered, where the appropriate company's objective cannot be understood by just including the growth share matrix, there are additional factors which need to be analyzed. And hence, a multi-factor portfolio matrix was included. That is the GE matrix. Now here, General Electric pioneered in this aspect, and hence we say it's a GE matrix, the name. Now here, at one end, the industry attractiveness is taken into account, and at the other end, the company strength of business unit. So here, the SBUs are marked on the basis of low, medium, and high considerations for industry attractiveness, as well as low, medium, high in terms of competitive strength of that particular business unit. Now, each businesses are rated in terms of these 9 cells, okay, by taking into account these two important factors. The businesses are divided into 9 cells. Now, these two factors make excellent marketing sense for rating a business. The companies are successful in terms of marking the attractive market and the core competencies. or the strengths of the organization to succeed in those markets. If some of the factor is missing, then the businesses will see a gap in it. It will not be able to give the output as desired here. So the strategic managers or the planners, they will have to identify the factors in terms of each dimension and then find a way to understand, compare, and combine them. Now, this G model, it helps the strategic planners to understand more factors in evaluating the actual and futuristic business view than the BCG model. In terms of BCG model, we just consider the two options, but here one can think of having more options. So here also, if the company thinks of rating, okay, on various perspectives or various attributes, like what is the overall market size in terms of market attractiveness as well as its current position. So whether the market size itself is very low, is it medium, is it high? And then you map the competitive strength of that particular business unit. So if the industry attractiveness is medium and even the competitive strength is medium, then it is okay. It will think of having the hold as a strategy. Because anywhere, even though the company thinks of trying to come up with more investments or try to improve the status, because there is a problem with reference to limitation of overall market size, there is no point in taking the efforts to improve the situation. Similarly, what are the technological requirements? If suppose the company thinks of improving through the intervention of technology, whether the situation of the organization will change, whether it will have the competitive position or gain the competitive edge in the market, that is the another question. What are the environmental considerations? Now, when we say industry attractiveness, if you take into account the government norms or the environment from the point of view of environmentalists, what is the industry attractiveness and where does the firm lie? If the firm has something, core strength, on the basis of this curbing out the aspects of environmental factors, so it can think of entering the market by strengthening this aspect and gaining the high in the quadrant of high industry attractiveness as well as high competitive strength, where the company can think of growing the business in that quadrant. Similarly, if one takes into account the research and development or the brand reputation part, this is the core strength of the company. So here, when the company thinks of extending the same brand to some other offering, it helps to improve the market share in the market. The industry attractiveness is more, and hence the company thinks of investing less in terms of introducing the new offering under the brand extension part. Like I had given you just an example of Maggie, where it came up with the same strategy of extending the brand to other products, which for those products which are on the same lines, that is the FMCG category. Now here, when we speak of business strength, the market share of the company, uh, the share growth, the product quality, brand reputation, the distribution channel, promotional effectiveness, production capacity, material supplies, research and development, the people or the managerial person capabilities, all these are reflections of competitive strength of the business. When we see the industry attractiveness, they are guarded by the external factors. Like one cannot think of having controlling the overall market size, the annual growth rate of that sector, the competitive intensity, how many competitors are there, the technological improvements which are taking place, the inflation, the environmental impact, or the social, political, legal aspects. All these are with reference to external environment. Now here, if we see each cell out of this 9 cell indicates its own situation. Now here the 3 cells in the upper left corner, they indicate strong SBUs in which the company should invest or grow, basically. The diagonal cells stretching from the lower left to the upper right, it indicates that the SBUs, the strategic business units, or the company product line, they are medium in overall attractiveness. Now, the company should think of having the selectivity when it thinks of investing, specifically where there is low attractiveness as well as the low competitive strength for the companies. The organization should be able to forecast the expected position of this particular business in the coming years. As I said, that each business has its own life cycle. And because of the external factors acting upon it, always the scene would not be the same. It would be changing. The basic objective is not always that to build the sales. It depends upon the company's mission statement, what it wants to achieve. Sometimes it is more profit, sometimes it is to gain the market share, sometimes it is just to sustain in the market when the competition is intense. Now the task of marketing management here is to manage demand or revenue to the target level negotiated with the corporate management. So here one cannot think of having the same demand for all of the businesses operating in the market. One may think of having more demand for one sector while other sector would be on a lower side. So when one thinks of having the critical analysis, here it helps managers to think more strategically, to understand the economics of the business more better by improving the quality of the planning. This improves the gap between the thinking of strategic business units and the corporate level managers. It helps to bridge the gaps. When maybe a corporate manager might think of bringing this particular strategic business unit at the same level of the other businesses. Okay, here the manager of that strategic business unit can intervene and explain the condition or the scenario for that particular strategic business unit when the corporate manager thinks of bringing it at the same level. So here these models must be used very meticulously, as based upon this the company is going to take future decisions. Now, since the businesses are dynamic, one never knows what would happen in future. What would be the future scene? That's why when the managers think of coming up with the decisions to invest, to hold, to divest, in those terms, it becomes really difficult for them to make the decision based upon just the current scenario. And hence, uh, the historical or the past history in terms of uh, profits or market share and the future perspective has to be looked upon. If for the continued time frame a particular brand is not performing well, it's better the company then withdraws it so that these resources can be used uh, somewhere else. Now this is about the GE matrix, the framework. Any doubts as far as two of the business portfolio matrix is discussed? So here the next part is organizational capability profile. This is the next point where the companies think of analyzing various functional areas and its sub factors on the basis of 5-point rating scales. So it is with reference to internal competency analyzation. Now analyzing the internal competency. The managers take into consideration the various functional areas like the financial part, the marketing part, operations, personnel, and the information systems and overall general management. So all the capability factors, okay, and their sub factors are also considered here, and a 5-point rating scale is developed with reference to different sub factors also. In between the scales range between -5 to +5. So here each and every factor is rated based upon the company's capabilities. We can say it's the internal competency mapping of the company. Now here if we take the financial capability factors, maybe the sources of funds is one of the aspect. Whether to go for the investments from the various shareholders or whether to improve the investment from including the stakeholders from within the company and outside the company. Like for the companies also have the IPOs, initial public offerings, they come up with the shares where even the other customers or the masses are included, or just to restrict it for the esteemed shareholders and the employees. Now it depends upon the company how it thinks of raising the funds, or go for tie-ups with the financial organizations like the banks, avail the loan facility from the banks. So here the company has to think from the financial perspective how it would try to improve the financial position of the organization by various permutation and combination of funds generation. There are different options available, but how the company thinks of giving the due weightage to the particular party or particular option when it takes in terms of decision of uh, improving the financial flow or financial investments part. How the company uses the funds is other aspect. One thing is generation of the funds. Second thing is managing the funds, or one can say utilizing the funds properly. Since the company has to use the finances very meticulously, here it has to decide in terms of using the funds properly and accurately. Suppose now here the companies have raised the fund and it's supporting the dogs. It's investing in the dogs where there is already a problem, where maybe there is the question of dilution of brand, where the uh, company is not getting profits, is not receiving any profits in terms of a particular product. There is no point in investing in such type of product. So here, that's why it said that the fund should be used meticulously. Similarly, the management of funds, whether to procure more raw material, whether to invest in plant and machinery, or in R&D. It depends upon the company how to utilize the funds and its allocation. The next is with reference to marketing capability factors. It is related to the product portfolio of the company. If a particular brand is not performing well, if a particular offering is not performing well, whether to continue with the same cycle of production, or whether to hold back or just prune the line, that is just stop the manufacturing of that particular uh, offering. Now here it is a trade-off. Now here, instead of just investing in such a product, the company thinks of just cutting down that line and investing the same resource in some other better performing brand. Similarly, price. When the market share of a company increases, when the uh, product penetrates into the market, and both of them are balanced, that is the market share as well as the profits. So here the company enjoys the economies of the scale when the company has a spread of goods or offerings in the market. It can enjoy the economies of the scales. Here even the products can be offered to the customer at the lower price. It also helps in decrease of per unit cost of that offering. Now those products which enter into the market with the brand extension, for them there is no need to spend more on the promotional attribute. There is no need for the companies to invest in promotions, maybe in terms of advertising or pushing through the retailers, distributors. As the people are aware about the brand, ultimately when any product is launched under the same brand umbrella, there is a possibility of penetration of that offering more, and low emphasis can be given on the promotion. Similarly, when the company takes into account the operations capability factors, that is the production systems, the operations and control of the systems, and the research and development part. So here, it depends again upon many factors like whether the goods are perishable, whether it maps the supply and the demand part, whether they are the specialized item where the company has an edge and customer is ready to wait for certain time, or whether there are competitors and here the company has no option but to match the supplies with the demand. Suppose if the products are demanded are in more speeder than the supplies provided, so there is a mismatch between the demand and the supply, then in that case the customer will not wait. If the competitor is more quicker in terms of production and mapping of demand and supply, the customer will shift to the competitor. Here the company cannot hold the market share if it delays in terms of production systems. So here it depends basically upon the demand for the offerings, the scenario of the market, and the company position in terms of its monopoly or the leadership position, we can say. How much funds should be allocated to the research and development is again a different aspect where the companies have to think about this. Next is the personal capability factors. Each and every company differs in their personal capability factors. Companies are investing huge amount in training and development of the employees. They see to it that these are their investments. A highly motivated personnel, a highly qualified personnel will always help in taking the company ahead in terms of its performance. If the people are motivated, if the people are talented, then only one can think of having the better prospects for the organization. Today, companies also spend huge amount in retaining the employees. The employees are given more benefits in terms of monetary policy. Policies are developed in terms of monetary as well as non-monetary aspects. As far as the industrial relations are considered, a harmony is maintained between the management and the employees, because disturbed relations will again have impact on the performance of the various activities of the company. The information management capability factors include the acquisition and retention of information, since today it's an era of data analytics. The transmission of data, the dissemination of information, processing it, usage of information, and integration with other general management aspects is a challenge today. Companies are also focusing on this maintenance of the data management as well as the data analytics part. Now, the general management capabilities include these internal factors as well as maintaining relations with the external factors, external stakeholders, and in general, maintaining the organizational climate. Now, after analyzing all of these factors and giving them a particular ratings in between -5 to +5, the company thinks of having an analysis, thorough analysis, and identifying the areas where it is performing very well and where it is performing below the expected margin. Here, the gaps are identified, and the managers think of exploring the opportunities wherever the options are satisfactory, while the gaps are filled where there is scope of improvement. Now here it depends solely on the organization's resources, the urgency or the priority of the organization, the state in which the competitors are there, and the organizational capabilities. That is the inner core strengths of the organization. Based upon this, the company prepares strategic advantage profile. Now, looking into all these factors, the company moves ahead with the strategy, maintaining of the or preparing of the strategic advantage profile. Here, based upon the capabilities with reference to this different operational factors and the rating, the company thinks of preparing this strategic advantage profile, which initiates the action to cover the gaps and use the company's strengths in terms of external threats and opportunities. Now, coming to the concept of stretch, leverage, and fit. Now, stretch is a misfit between the resources and the aspirations or the objectives or the dreams of the organization. That is the gap in between what is the current position of the organization and where it wants to reach. That is a stretch. Now, leverage refers to the concentrating, accumulating, complementing, and conserving the resources in such a way that peer resource is stretched to meet the objectives or the dreams of the organization. Now, stretch is opposite of the fit, matching the organization resources with the external environment, that is stretching of the core competencies. The strategic fit is central to the strategy of positioning. That is the SWOT analysis, which is used for analysis of the organizational capabilities and environmental opportunities. Here, the strengths based upon this analysis of internal factors, the company thinks of exploring the opportunities, or maybe if there are threats in the environmental scanning part, the company tries to fit or adjust these internal core strengths of the organization. Now here, strategy is a compromise between what the environmental factor has to offer in terms of opportunities and counter offer that the organization makes in the form of its capabilities. The more capable is the organization, the more proactive it is in terms of exploring the opportunities. Under the fit option, strategic intent seems to be more realistic, and under the stretch and leverage, it could be idealistic, one can say. So here it depends solely on the company or the organization whether to go for a fit strategy or whether to explore the new opportunities by fully utilizing the core competencies or the capabilities of the organization. So have you understood the part of organizational capability profile? So this is about the organizational core competencies. Now today we end up with this chapter of internal analysis of the core capabilities or core competencies part. In the next session, we would start with the generic competitive strategies, which usually focus on the differentiation and the diversification strategies. Now, based upon this portfolio analysis, the company thinks of having the designing of different strategies that we will see in the next session. We will stop here. Thank you, students.
Thank you, ma'am.